The global financial system was rocked this week, sending shockwaves through trading floors and boardrooms from New York to Shanghai. Investors, analysts, and policymakers alike scrambled to make sense of a development that could reshape the very foundations of international commerce. The cause? A bold and unprecedented move from the White House, signaling a dramatic escalation in the ongoing economic rivalry between the United States and China. Former President Donald Trump, never one to shy away from confrontation, has unveiled sweeping new rules aimed squarely at curbing China's growing influence on the world stage. This time, the battleground isn't just about tariffs or technology, it's about the very currency that fuels global energy markets. Trump's administration is taking direct aim at the use of the Chinese yuan in international oil transactions, a move that could have far-reaching consequences for the global economy. The new policy is unambiguous. Any bank, regardless of its location or size, that is caught settling oil trades in yuan will face the ultimate penalty: being cut off from the U.S. financial system. This is not just a warning, it's a threat with teeth, backed by the full weight of American economic power. For global banks, the prospect of losing access to the U.S. dollar is nothing short of catastrophic. The dollar remains the world's primary reserve currency, the backbone of international trade and finance. To be exiled from this system is to be cut off from the lifeblood of global commerce, an existential threat that could spell ruin for even the largest financial institutions. This is more than a simple policy shift. It's a stark financial ultimatum. Banks and nations alike are being forced to make a choice: align with the United States and its dollar-dominated system, or risk isolation by siding with China's alternative vision for global finance. The stakes have never been higher, and the pressure is mounting on all sides. The battleground has shifted decisively. No longer confined to tariffs, trade disputes, or technology bans, the conflict now centers on the heart of global finance, currency markets, and the international banking system. Every fluctuation in exchange rates, every shift in capital flows, is now a potential flashpoint in this escalating struggle. The United States is drawing a clear line in the sand, determined to defend the dollar's dominance in the oil market at all costs. By targeting the mechanisms that allow the yuan to gain ground in energy trading, Washington is sending a message to allies and adversaries alike. The era of dollar supremacy is not over yet. By zeroing in on the yuan's expanding role in global energy markets, Washington is escalating the economic conflict to a new, volatile front. The implications are profound, not just for China and the US, but for every nation and corporation that relies on stable, predictable financial systems to power their economies. This is no longer just a trade dispute or a battle over tariffs. It's a struggle for control over the very architecture of the global financial system, a contest that will shape the future of money, power, and influence for decades to come. As the world watches with bated breath, the stakes in this high-stakes financial war continue to rise, leaving no one untouched by the ripples of this historic confrontation. To truly grasp why the United States is so protective of its currency, you first need to understand the immense power of the petrodollar system, a system that has shaped global economics and politics for decades. Since the 1970s, a pivotal agreement ensured that oil would be priced exclusively in US dollars. This move wasn't just about convenience, it fundamentally changed the world's relationship with the dollar. Suddenly, every nation that needed oil, essentially every nation on Earth, also needed dollars. This created a relentless built-in global demand for the US currency, making it the lifeblood of international trade. This exorbitant privilege allows the US government to borrow at lower costs and run persistent deficits because the world's appetite for dollars never fades. The US can print money to finance its spending, knowing that other countries will absorb those dollars to buy oil and settle global transactions. Central banks across the globe stockpile dollars as reserves, reinforcing the dollar's status as the world's primary reserve currency. This cycle strengthens America's financial influence and gives it unique leverage over the global economy. Any disruption or threat to this system isn't just a minor inconvenience, it's a direct challenge to the core of American economic power and its ability to project influence worldwide. If oil producers start accepting other currencies like the euro, yuan, or even cryptocurrencies, the global demand for dollars could plummet. This would risk a sharp devaluation of the dollar, trigger higher inflation at home, and undermine America's ability to finance its debt. That's why every US administration, regardless of party, fiercely protects the dollar's dominance in energy markets. It's not just about economics, it's about national security and maintaining America's global standing. When President Trump took action against China, it wasn't simply a trade dispute, it was a calculated move to defend the very foundation of American influence, the dollar's central role in the world's most vital commodity market. The message is clear: the oil market is dollar territory. Any attempt to challenge this order will be met with strong resistance, because for America, the stakes couldn't be higher. China has spent years trying to elevate the yuan's global status, aiming to reduce its dependence on the dollar. The launch of yuan-denominated oil futures in Shanghai in 2018 was a game-changer, letting oil producers bypass the dollar. By linking these contracts to gold, China made the yuan more attractive to wary exporters. Russia, Iran, and even some Gulf states have started accepting yuan for oil, giving China a growing foothold. By late 2023, the yuan accounted for about 15% of global oil trade, a significant shift. This progress alarms Washington as China's ambitions are both economic and geopolitical. The petro-yuan weakens U.S. leverage and boosts China's global influence. The rise of the petro-yuan signals a move toward a multipolar financial world. The new U.S. rules have put global banks in an impossible position, forcing them to navigate a rapidly shifting landscape where every decision carries enormous consequences. These regulations are not just technicalities. They're reshaping the very foundation of international finance. Giants like HSBC and JP Morgan, which have built their empires on cross-border business, now find themselves caught between two economic superpowers. Both the US and China are essential for their profits, growth, and long-term survival. Losing access to the US dollar, the world's dominant reserve currency, would cripple any bank's international operations, making it nearly impossible to conduct global transactions or serve multinational clients. But at the same time, China's market is simply too big to ignore. As the yuan's role in global energy and trade continues to grow, banks are under pressure to maintain strong ties with Chinese partners and customers. In response, banks are scrambling to assess risks, reviewing thousands of transactions and client relationships. Some have already started suspending deals that might violate US sanctions, hoping to avoid costly penalties or reputational damage. They're walking a tightrope, trying to comply with US demands without alienating China, a balancing act that grows more precarious with every new policy announcement. The result is a climate of deep uncertainty. Capital flows are slowing, investment decisions are delayed, and the once seamless global financial system is starting to fragment along geopolitical lines. The era of globalization's unified rules is fading, replaced by a world of competing spheres of influence where banks must constantly adapt to shifting alliances and regulations. For banks, every move is fraught with risk. One misstep could mean devastating sanctions, lost business, or even exclusion from entire markets. The stakes have never been higher. The path forward is anything but clear, and for global banks, the future is now defined by uncertainty, complexity, and the constant need to adapt. Beijing's response was swift and fierce, condemning the US move as financial bullying. China is urging oil exporters to keep using the yuan and promoting its own payment system, CIPs, as an alternative to SWIFT. By expanding CIPS, China hopes to build a parallel financial network, shielded from US sanctions. Russia and Iran back China, seeing the petro-yuan as a way to escape US pressure. But US allies in Europe and Asia are caught in the middle, torn between economic ties to China and security ties to the US. The EU and others worry this conflict could destabilize global markets and force them into difficult choices. The world's financial alliances are being tested as never before. This financial showdown has real-world consequences, starting with oil prices. Disrupted settlements and nervous banks could trigger price spikes and volatility in energy markets. The broader impact global trade slows as tariffs and financial uncertainty mount. The World Bank has already cut growth forecasts, citing trade turbulence and financial friction. US imports from China have plunged, and recession risks are rising. Stagflation, stagnant growth and rising prices, looms as a threat. Fragmented trade and finance mean higher costs, unreliable supply chains, and less investment. The global economy is becoming less efficient and more fragile. The financial war over the yuan is reshaping the world's economic outlook. Behind the headlines, real people and businesses are feeling the pain. Multinationals like FedEx and General Mills report falling profits, blaming trade and financial uncertainty. In Ireland and Japan, entire industries face job losses as tariffs threaten exports. For consumers, tariffs mean higher prices and fewer choices. Confidence is falling as costs rise. Small businesses must choose between absorbing costs, finding new suppliers, or shutting down. Even students and families are caught in the crossfire, facing new barriers and anxieties. The grand strategies of nations have direct personal consequences. The human cost of this financial war is mounting every day. America's financial offensive is straining old alliances. Tariffs on the EU, Canada, and Japan have sparked retaliation and undermined unity among Western partners. Urgent trade talks are underway, but tensions run high and deadlines loom. Instead of a united front against China, the US is fighting on multiple trade fronts, risking isolation. Some countries like the UK are seeking new deals, while others look to China and Russia for alternatives. The post-war order of strong alliances and free trade is eroding. A more chaotic, transactional world is emerging with shifting alliances and rising uncertainty. The financial war on the yuan is redrawing the global map. The US challenge to the petro-yuan marks a turning point in economic history. Financial globalization is giving way to open confrontation between the US and China. The outcome is uncertain, but instability and volatility are here to stay. If the US keeps wielding financial power as a weapon, more countries may join China's alternative systems. A bipolar world, dollar versus yuan, could emerge, less efficient and more divided. This conflict forces nations and corporations to rethink their allegiances and strategies. The future may be one of cooperation or raw competition. Today's choices will shape tomorrow's world. The battle over the petro-yuan is just the beginning of a new, uncertain era. As the dust settles on the latest developments, the world stands at a crossroads. The choices made in the coming months will set the course for decades to come. What lies ahead remains to be seen. In our next chapter, we'll explore the unfolding consequences, emerging trends, and possible solutions as nations and markets navigate this uncharted territory. Stay tuned for a deeper dive into the future of global finance as the story continues to evolve. As we close this chapter, the saga is far from over. The financial landscape continues to shift, and new stories are waiting to unfold. In our upcoming episode, we'll delve even deeper, exploring fresh developments, untold perspectives, and the next moves in this global economic chess game. Join us next time as we uncover what the future may hold. Until then, thank you for watching, and stay tuned for the next chapter.